of the upcoming IRA Planning Workshop, SECURE Act Strategies for Guiding Clients Right Now. This workshop will be a 4-day virtual workshop running from April 24th through the 27th. And if you want to learn more about the workshop or go ahead and sign up, you can do so at horsesmouth.com/IRA workshop. For those of you joining us in Zoom, I'll go ahead and put the link into the chat panel right now. So in today's preview, Jeffrey Levine, the leader of the workshop, is joining Horse's Mouth editor-in-chief Sean Bailey to talk about what he'll be covering during day 2 of the workshop, including contributions and deductions continued, session 4, integrating IRA planning with the client's overall plan, and session 5, Roth planning for 2023 and beyond. So Sean, I'll go ahead and hand it over to you.
Hey, Doug, thanks. Hi, everyone. Thanks for being here. Hey, Jeff, I wanted to tell you something before we get going.
All right.
I just got an email the other day from somebody who's a savvy IRA member, and they've been dripping on their prospect list about the importance of the SECURE Act for a long time, because we've been writing about it for a couple of years. And she went ahead and put on the SECURE Act 2.0 webinar, and guess what happened? Some guy who's been on her list for 9 years said that the webinar was great. I'm finally convinced. Here's $1 million account, and now you're doing business. So, I mean, this stuff, it works, right? People are out there. They need this information.
That's right. They're looking for some place to get it. And if you can give them that information, that education, that's what people are looking for. No doubt about it.
Yep.
That's awesome.
Yep.
Well, good for that advisor, not only for doing that proactively and educating, but for sticking with that person for 9 long years. But you know what? That's why this is a business where if you stick through it, you make it through that initial phase, now you start getting those people. Next year, you get the person who was there for 9 years, the year after, like things start to come a lot easier down the road.
You're absolutely right. I mean, as I tell advisors, often that in your list, there is value in building your email list, even if it's, your total list is 25% client households and 75% people who aren't clients yet. Embedded in that list is revenue and future clients. They're just waiting for the right time. And as long as you're cultivating the list, nurturing it, dripping on it, something we talk a lot about with our advisor client program, dripping on these people, letting them know, hey, you're on top of it. You're following all these things. Well, sooner or later, the time comes and boom, they become clients. So let's dive right into this, because this is a live stream. It's not a full-on webinar. We're kind of just having a conversation about some of the things you're going to be talking about. So as Doug was saying, the workshop runs from the 24th to the 27th. And day 2, we're going to be talking about contributions and deductions, right? So one of the things you're going to be talking about is strategies to minimize exposure to that 3.8% net investment income surtax. Why is it important for advisors to know about that and be fluent?
Well, I think one of the interesting elements of this 3.8% surtax is that it's not technically imposed on IRA distributions, but in a way it sort of is. And the reason I say that is, you might have a client with $250,000 of income, and it doesn't matter where it comes from, whether it's IRAs, all interest from the bank, whether it's dividends, capital gains. If they have $250,000 of income and they're a married couple, they don't pay this surtax no matter what, right? Because they're below their applicable threshold. And by the way, one other thing, Sean, just kind of as a side note, that $250,000 threshold, now we're in 2023, when this first began to impact people back in 2013, so literally a decade ago, before now. Do you remember what the limit was in that year?
No.
$250,000.
It's the same thing, right? Okay,
the exact same thing it is today. So,
right.
We have seen, even though inflation for a long time was relatively modest, even 2 or 3 or 4% inflation over a period of 10 years means things go up, incomes go up, wages go up, et cetera. And of course, recently, inflation has been a lot hotter than that. So more and more and more people have become subject to this 3.8% surtax each year on a relative basis. So this is something that advisors, if they're not already familiar with, they need to get themselves familiar with, because more and more and more people will continue to become subject to that surtax. Now, the interesting thing is, once you go over $250,000 of income, then your investment income becomes subject to this surtax. But what pushes you over could be anything, including, for instance, IRA distributions, right? So you could have an IRA that, a nice big RMD, or maybe a Roth conversion, for instance, right? And either of those, if it pushes you above that applicable threshold, now all of a sudden, where your capital gains, your interest, your dividends weren't subject to the surtax before, now all of a sudden it's like $4,000, 4% more in taxes. On $100,000, that's a $4,000 additional tax that no one wants to pay. And I point out one other thing here. We keep saying $250,000 of income, $250,000 of income. Well, that raises the other question, which is, what is income? What defines income for this purpose? And like many things in the tax code, it's AGI, or actually a derivative of AGI here, MAGI, technically, modified adjusted gross income, which is really adjusted gross income further adjusted again, right? But effectively, it's AGI, which means that all of the big deductions that people normally take, things like mortgage interest and big charitable contributions and things like that, do nothing to help minimize this surtax. And that's one of the critical elements that advisors should be aware of. Now, on the flip side, some of the few deductions that do help to reduce AGI are things like the IRA contribution deduction, if you're eligible. There are also things like the self-employed retirement plan contribution deductions. If you have even if you're not self-employed, but you defer salary at work, that too will help you reduce your AGI, which can help minimize exposure to the surtax and all of the other nasty things that happens as your income goes higher. And I think that's one of the critical things across the board for advisors really to grasp is when we're talking about income thresholds or income limits, et cetera, what are we talking about? What defines income for that purpose? Because as we always talk about, Sean, there's about 1 billion different definitions of income, right? You've got taxable income, adjusted gross income, provisional income, tax-free income. You've got then you've got modified adjusted, right? I mean, the list goes on, and all of them have these little adjustments here and there, and it doesn't matter until it does.
Right. Yes, and there's a guy, Mike Pierschow from Illinois, and he talks about one of the reasons to be fluid with this sort of stuff around your clients is because you look like an absolute genius when you're able to identify these kinds of potential problems that your clients are heading right down the road toward and be able to steer them away from it, whenever possible. And speaking of those kinds of things, one of the other things you're going to be covering is avoiding common 10% early distribution penalty exception mistakes.
Mm-hmm.
Why does someone need to know their way around that one?
Well, unfortunately, while we all want people to put away money for retirement and to leave it there for retirement, there are a variety of reasons why people from time to time need to access that money sooner. There's some sort of emergency in the family, some sort of unexpected expense. Maybe it's just someone retired early, right? Maybe you retire at 50. Good for you. Well, what are you going to do? How are you going to fund that? If a lot of your money is tied up in your retirement accounts, you need to have a way to access that, or at least a plan to access that without incurring the 10% penalty on top of your regular tax bill. And that 10% penalty, Sean, is applicable even if you have negative income. One of the things, there was a court case a number of years ago, person had negative income, like, we don't even have a tax bill. How could we have a 10% penalty? And the court said, well, that's your regular taxes, but you can't offset your regular taxes with this additional 10% penalty. So, this is one of those things that we are seeing more and more. And to that line of thinking, Sean, the SECURE Act 2.0, which just was passed here a couple of months ago by Congress, it dramatically expanded the ability for people to take money out of their retirement accounts before 59.5 without a 10% penalty. There are so many nuanced exceptions now. I mean, we've had what I kind of call like the classic rock set for a long time, like the oldies, if you will, right? Like death, disability, first-time home buyer, education, all those sorts of things for a long time. And now we've got like the new age, funk coming through. And it's things like, not to make light of these things, but like new terminal illness exception, right? There are new exceptions and expansions of the age 50 exception for public safety workers, where now private sector firefighters are included with public safety workers for I mean, the list of exceptions goes on, and really there's what we typically find is mistakes happen in one of two areas. Either the actual rules themselves are not well understood, there's some sort of nuance to the rule where there's a mistake, or someone is taking the wrong type or distribution from the wrong type of account. So what I mean by that is, first, a rules-based error. A great example of that, I'll call back to a court case from a number of years ago, Gail Marie Watson. Gail Marie Watson was someone who retired from work in her early 50s and did not touch her 401k until she turned 55, because she had heard about this age 55 exception. So she left it alone and then turned 55 and then took a distribution from her 401k after turning 55. The IRS hit her not only with income tax on the distribution, but also a 10% penalty. And she said, but I'm 55 and there's an age 55 exception. Well, the devil's in the details. In order for that exception to apply, you have to actually separate from service in the year you turn 55. Now, that doesn't mean you have to actually be 55 that day. Someone could separate from service today, turn 55 on December 31st this year, and they would still qualify. But they can't, if they turn 55 January 1st next year, separating from service today doesn't work. So there are little nuances to the rules that can make these things somewhat complicated. I mean, some of the things don't even make sense when you think about them, like the first-time homebuyer exception. Theoretically, the rules, if you have the right set of circumstances, could allow you to be a first-time homebuyer for a second time. I mean, things that just
really
boggle your mind. Yeah, if you didn't use your full 10,000 and then you didn't own a home for 2 years, I mean, it would take a series of things to occur.
Right,
but theoretically, right, you could be a first-time homebuyer for a second time, which doesn't make any sense, but not our tax laws don't. And that's why, folks like you and I are here to talk about this with advisors who are here to talk about it with their clients and who need them desperately. So the other category of mistake that we see here is the mistake where you take a distribution from the wrong type of an account. Now, some of these exceptions that exist are what I refer to as universal exceptions, meaning if you have an IRA or a 401k, it doesn't matter. You can take it from either one. So for instance, if someone dies, the beneficiary, no 10% penalty, no matter what type of an account they take it from. Someone who had a medical expense, right? Doesn't matter. You could take it from an IRA or 401k. But then there are some plan specific exceptions. So things like a quadro, if you get divorced, right? And you are receiving a part of someone's 401k or pension plan or 403b as part of this divorce process, if you take the money out of the plan after receiving it from your ex-spouse, pursuant to the quadro, you could be any age and have that be 10% penalty free. Similarly, the age 55 exception we talked about before only applies to plans. The age 50 exception only applies to, there are a number of plan only exceptions. On the other side, there are IRA only exceptions too. For instance, the exception for education expenses is an IRA only exception. And the tax court history is littered with people who have argued, hey, I took money from my 401k, but I could have just moved it to my IRA yesterday and then today taken the distribution from my IRA. So what's the big deal? And the courts have consistently said, well, the big deal is that's not how you do it, right? It has to, the 1099-R has to come from the right type of an account. So, just having the knowledge of what happens where, or if not the knowledge of knowing that not all of them apply to each, and having a resource to go to where you can look at it in the moment of need. You say, oh, well, hold on, Mr. and Mrs. Smith, before we take any distributions, let me make sure that the account you're thinking about taking a distribution from actually can benefit from this exception. Because if not, maybe we just pick it up and move it somewhere else where the exception applies.
Right. As Debbie Taylor says, this is about issue spotting, something that, they teach you in law school, but it's just it's a conceptual approach. It's like, you don't need to know all this stuff, like you do, but you do need to be able to spot the issues that your clients have, see that there's a red flag there, and then dive in more deeply.
That's right.
So session 4, you're going to be talking about integrating IRA planning with the client's overall plans. One of the things that you're going to be doing is talking about coordinating the distributions with the Social Security benefits. This always gets people confused, I think. Can you talk about why it's so important for advisors to know their way around that one?
Yeah, I think at a high level, right? And I've said this many times when we've been together, Sean, the IRAs to me are always fun to deal with because they are, in many ways, the octopuses of the planning world. They have tentacles that reach out into every element of planning. So they impact your tax planning, they impact your estate planning, they impact your investment planning, they can impact education planning, they can impact, as we're going to talk about here, Social Security planning. So they really have an impact across the board, and there's not a lot of other things that you can say that about. Now, with respect to Social Security planning in particular, it sort of overlays the Social Security rules on top of the IRA rules, or vice versa, right? But it's really looking at these things in their totality. And one of the things that we know is that the more you delay Social Security, the higher your check for the rest of your lifetime will be. But of course, if you wait longer, you get fewer years of checks, right? So there's this inherent decision on the Social Security side of when do I take, do I delay, et cetera. But then there's also this notion of how does that coordinate with my retirement accounts? Because if you die and you had waited and taken Social Security later, let's just remove a spouse for a second. Let's just say it's a single individual or a survivor. When you die, that check is going to go away. And even if you had a big check because you waited, that big check is going to away. Nothing really is benefiting your heirs. Whereas if you have an IRA and you are able to leave it alone because you start taking Social Security perhaps earlier, well, you might have more of your IRA in those early years to pass on. Question becomes, how do you coordinate these things to get the most? And, I probably doesn't come as a surprise to a lot of advisors, but delaying Social Security continues to be a good value play, even when it means burning through the IRA earlier. And not to say that's always the case, because obviously that depends upon, I always say, you want me to tell you your perfect Social Security strategy? Just tell me the day you're going to die and I'll be happy to do so. But absent that, absent knowing exactly when someone's going to die, then we've got to look at the facts and situations and circumstances that surround things. And delaying Social Security and using IRA can be valuable for a variety of reasons. One is we look at effectively the cost of buying an annuity with your IRA dollars versus delaying Social Security, right? Which is effectively an annuity. And people say, well, you're not really buying an annuity. Well, you kind of are, right? The distributions or the benefits you forego in any one year is effectively your premium, and the annuity you're buying is the difference, the increase in the benefit you would get this year versus the benefit you get next year. If you look at that and compare it to what you could buy on a commercial market, that's going to be less expensive by delaying Social Security. So the next thing we might look at is say, okay, well, what's the taxation of these two types of income, right? Because it always comes back to taxes. Well, on the IRA side of things, if you take $1 out of your retirement account, you're going to be taxed in general on at least $1. Right? Social Security in a worst case scenario is taxed 85 cents on the dollar. So there's an inherent tax efficiency where trading $1 of IRA income for $1 of Social Security income later on actually results in a net benefit to the client in almost all circumstances, because the Social Security income is a more efficient form of taxation or is taxed more efficiently. However, and the big however here is, Social Security can also become subject to what is commonly referred to as the tax torpedo, right? Where you take $1 of IRA additional income, and this typically applies to those with more modest income, right? Not the $100,000, $200,000 a year retirement income, but mom and pop, right? What I'm gonna overly simplify now that I live in the Midwest. I'm gonna say middle America, right? And say like those, might be $30,000, $40,000, $50,000 of taxable income. So it could be more income, but taxable income during the year. And, all of a sudden you find that you do some analysis and these, mom and pop type folks are paying 40% in some cases marginal tax rate on their Social Security or on a portion of their income. And it's because they're getting hit with this so-called Social Security tax torpedo, which effectively can result in paying a tax rate that is 185% of the actual tax bracket you're in. Right. So if you're in a 10% tax bracket, you might actually be paying a real 18.5% rate. If you're in a 22% bracket, that equates to a 40.7% tax rate, which, by the way, Sean, our top rate for those who make like millions and millions and millions of dollars of all ordinary income isn't even as high as 40.7%. So it's one of those things where we have to look proactively and say, hey, Mr. and Mrs. Smith, we have to time these distributions appropriately. It might mean pulling income out beforehand to do Roth conversions when you're only, quote unquote, in a 22% bracket, so that later on we avoid you getting hit with the tax torpedo when your rate would otherwise be 40+%. Again, there is no tax bracket that high, but it doesn't matter what the tax bracket says. It matters what your rate is. And that's something we focus on heavily in the course, is understanding the difference between those two and how to look at them in the right way, right? Ultimately, the tax bracket helps to inform what the rate is. But the rate is really the critical element here, right? If you tell me you're phasing me out of credits, you're phasing me out of deductions, you're triggering surtaxes, you're increasing Medicare Part B premiums, all of those things don't necessarily show up on the tax bracket, but they impact how much I'm going to pay. And ultimately, how much I pay or don't pay is what I care about.
Right. Yeah. And then there's this additional issue of what happens when people divorce with the retirement accounts. That's another subject you're going to be covering on day 2. And the things you were just saying, throw in divorce, and it gets even more complicated.
Oh, yeah. Well, first off, right, the fact that all retirement accounts don't get split the same way is something that is a common issue that arises in divorce. We get questions all the time from advisors saying like, hey, I'm trying to get a quadro for the IRA so we can split it. Well, IRAs don't get split with a quadro. Plans get split with a quadro. IRAs don't. IRAs, you go to court, you get a divorce agreement or a marital separation agreement that's agreed to, and you submit that to the custodian, and it's split at the custodial level. You don't have to get the court involved to the same extent where you get a formal court order to go and split something like a 401k. Now, there's other differences, right? We talked about the quadro earlier. I said if you take money out of a plan pursuant to a quadro, right? You're an ex-spouse, you just got half of your ex-wife's 401k, and now you want to take some of it out. You don't have a 10% penalty if you do that from the plan because it's a quadro exception. Sean, we just said quadros don't apply to IRAs. So when you split IRAs, there is no 10% penalty exception. So there are all of these types of things that, these little nuances. And again, I keep saying it doesn't matter until it does. And, that is both a defensive posture as well as an offensive posture, in the sense of if you stop yourself or you stop your clients from making silly mistakes, it eliminates the possibility of friction in the relationship. It eliminates clients losing money. And when clients lose money, it's less for them to have, which means it's less for you to help them with, which typically means it's less money for the advisor too. Like this is a very symbiotic relationship when things are done properly. The other element of this, though, is it's offensive, right? When you do that and you give great advice like that, and someone says, hey, I didn't know that, and no one else told me. And a lot of times, the divorce attorneys, they're, processing things a million ways till Sunday. They are interested in an equitable split of assets, but they don't always take into consideration the tax impact or the 10% penalty impact, but hey, I won't be working for the next 2 years. I need a bridge of income. What's the most effective place for the client to get it? May be different for both spouses. You can come up with creative solutions here, but you have to know the rules. You do that, though, and now all of a sudden, you're the talk of the town, so to speak. I mean, I don't really think people are going to be out there saying, hey, just guess what happened in my divorce. But, people are going to talk to their friends. The divorce attorneys I've seen over the years where advisors have stepped in help clients navigate, and even had conversations with the attorney saying, look, I know that, we could probably get more of this, but at the end of the day, the tax impact for my client, because they're in a high tax bracket, or it's the opposite, right? Like, hey, my client is not going to work. They're going to be in a low tax bracket. Let's go after a lot more of the IRA because they won't pay a lot of tax on it. And we'll let that higher earner over there keep all this other stuff. And they think it's more valuable because they're in a high tax bracket going forward, but my client doesn't have to worry about that. Those sorts of things I've seen the relationships with the attorneys blossom, where then they start referring over to the advisor as kind of like, hey, not only do you need your legal advice, but you should get your financial plan in order. And great relationships have developed over the years because of that sort of thing.
Right. Yeah. So we just got a couple minutes more. Let's just talk about Roth planning for the last minute or two.
Sure.
That's always a favorite and interesting topic. What are some of the key things you're going to be looking at? I guess, well, Secure Act 2.0 had some discussion of Roth, right? Not too much, but there were one or two interesting provisions. But you want to set the table on the Roth discussion?
Yeah, so there are really 4 to 5, depending upon how you want to look at the 529 plan to Roth, whether it's a 529 plan change or a Roth change. But there are 4 or 5 different changes to the rules for or rather because of Secure Act 2.0. But while we will mention those, the bigger focus for us is going to be on Roth conversion planning, because at the end of the day, if you have a retirement account, that account will be distributed at some point. The question is, when will it be distributed and what will the tax rate be? The Roth conversion is effectively an option to pay tax when you want to, which is an incredible ability to time your taxation. And we're going to talk about a few things. One, we'll talk about some strategies to make the most of Roth conversions, like how do you create a tax efficient Roth conversion once you know you're going to make a conversion. But the other thing we'll do is we'll spend some time, like you talked about issue spotting. I'm going to talk about people spotting here, right? It's like, what sort of people and what sort of circumstances should you be looking at Roth conversions for? And there are we kind of divided into 2 sections. We talk about the very obvious candidates and why it makes sense for certain people as almost like a no-brainer scenario, right? And I always say you've got to do your research. There's no such thing as no-brainer, but these are as close to a no-brainer scenario, as close to the automatic conversion switch as we can possibly have. But then we get into the list of less obvious candidates. For instance, Sean, I'll give you just one on the less obvious candidate scale. We talk a lot of the time about planning for couples, and we talk about your tax rate today versus your tax rate tomorrow. But a lot of times when we do that, we look at the couple as if they're going to live forever, like together. In other words, like that they'll both die at a similar point in time. And that may or may not happen. If it doesn't happen, and there is a significant difference in longevity, either because of age difference or health difference or whatever it may be, there might be a survivor who outlives the first to die by 5 years, 10 years, 20 years or more in some circumstances, right? And that survivor, if they don't get remarried, they go from being filers who file on the joint side to filers who use the single brackets. And the single brackets are effectively at the, the 10, the 12, the 22, the 24% rates, et cetera. They're half as big as the joint brackets, but you tend not to lose half of your income, right? You lose the lower Social Security check, and oftentimes that's it. Everything else that the deceased spouse was getting continues over to the surviving spouse. But now you have the same or pretty similar income in a lot of places, sometimes even more, because you might have had maybe a pop-up pension that popped up, or maybe you got life insurance benefits that have been reinvested. So sometimes it's more income than it was before. But let's just say slightly less income, but taxed at much narrower brackets can actually cause someone with less income to pay a much higher tax bill. So in effect, a Roth conversion becomes an insurance policy against those higher tax brackets. And by the way, that is something we focus on, Sean, is positioning this with clients, right? What is the right way to talk about this and frame this? And to a large degree, what Roth conversions are is tax insurance. And we talk a lot about that in the program as well. I know we're running out of time, so I'll zip it there, Sean, and turn it back to you. But
yeah, just to point out, I think Roth conversions particularly is a topic where advisors have a great opportunity to make headway with clients and prospects because they don't really know that much about it.
100%. I agree.
Yep. And that's the benefit of coming to your workshop, April 24th to the 27th. Thanks, everybody, for being with us today. Look for us again on April 10th at 4:30 p.m. Eastern Standard Time. Jeff, thanks for being here. Have a great day, everyone, and we'll see you again soon. Take care.